Just when you thought interest rates were finally heading south, the global economy throws us a curveball. Here are our official cash rate predictions.
We are back in your life, and it is another week with an OCR announcement on Wednesday. And Mike, life has got more complicated. There is more than meets the eye. Trump's back on the tariff train. We know a hell of a lot more. Adrian Orr is out the door. Let's break it all down. What does it all mean?
Yeah, look, so the tariffs are probably the big talking point. We'll get on to Adrian Orr in a little bit. Really, it's a whole lot of uncertainty, right? And there's kind of two ways you can look at that. Some people are looking at the tariffs and going, what does this mean for the official cash rate? Will they slow down the cutting? Or will they speed up the cutting, or will they just kind of stay the course, right, and keep 0.25, 0.25, 0.25? My personal opinion, I think they will just stay the course and keep going 0.25, 0.25, 0.25, which is what they've got tracked at the moment. Why would you argue that it could slow down the cutting? Well, in the short term, you might say, well, that's going to push inflation up because these tariffs are now making goods more expensive. So again, the whole point of raising the official cash rate is to decrease inflation, so that might slow it down. The downside risk, which is probably what I think more so than them slowing down the cutting, is it could force them to speed up the cutting. So if you think in the short term, yep, some overseas inflation might go up quite a bit more, our imported inflation, but the economic uncertainty caused by the trade tariffs could mean that our economy is in for a much rougher ride this year than it was otherwise expected to. So what does that mean? You drop the interest rate to stimulate the economy. So I actually think there's more chance that they would cut faster than they otherwise would have, as opposed to slowing down the cutting.
Michael, we said we'd wait till 2025 and then life would be okay. And then the orange man just makes life a little bit harder for us all, and there's a bit of uncertainty. Let's break down some of these numbers, though, in terms of the tariffs. So 10% on all imports, plus higher rates on China, 34%.
Yeah.
Vietnam at 46%, and the EU at 20%. Were you surprised by any of those numbers?
I don't really know if I was surprised. I don't think anyone knew what to expect, because what they're saying is these are reciprocal tariffs. You are doing this, so we're going to do this. The only problem is when he throws up the numbers of what the tariffs that other countries are putting on America, they're complete rubbish. Like there is no 60-something% tariff on goods in China or something like that. Like, it's all like, to get those numbers, the math is so wrong and you're making so many assumptions that, like, it's quite clear they're not just reciprocal tariffs. I think this is just posturing, a good stance to start a negotiation. And the other thing as well, fundamentally, the American economy runs trade deficits because that's how they're set up. It's not a bad thing, right? This idea that trade deficits are like a terrible thing for the country, I just don't know. Like, it doesn't make any economic sense.
Depends on the economy, right?
Yeah, it just like doesn't. They're also the reserve currency for the world. They're almost always going to be running trade deficits. So I don't understand why it's such a bad thing.
So, I mean, the other bit, like the US is just quite a lot going on, right? I mean, you look at the share market, the S&P 500's dropped nearly 5%, which is a whopping $2.5 trillion, the biggest fall.
US. Yeah, 5 trillion NZ.
Yeah, biggest fall since 2020. Obviously, there's geopolitical risk. There's China, there is Russia and China's relationship, a whole different amount of components here. These tariffs, how much? What does it do to our geopolitical risk? And
in the short term, I don't think it's geopolitical risk, James, but in terms of our the economic performance of the country, in the short term could actually be quite a positive thing. If you look at it from that angle, we only got a 10% tariff, which basically everyone else got, or you got more than that. So comparatively, our goods in our second largest trading partner, or our largest trading partner, I can't quite remember, being the States, will be cheaper than all of the other imported goods, right? Because if you think, I don't know, Vietnamese wine is now 49% more expensive in the States compared to New Zealand wine, which is only 10% more expensive. You might be reaching for a bottle of Marlborough Sav as opposed to a Vietnamese Pinot Noir.
But I've never heard of Vietnamese wine before.
It's great.
They got many vineyards in Vietnam.
Som Bro, run.
Yeah.
In terms of, I think in the short term, probably like direct impacts, not that much, pretty minor. It's the second order impacts which are really going to hurt the country. And that is, we are a nation which is set up to trade, right? And if our biggest economies are slowing down, in terms of our trading partners, China, Australia, the US, that's going to have some real impacts to us. Yeah.
What about when it comes to the idea that there's information that the Reserve Bank isn't quite sure what to do with, and they're still trying to process, and they're trying to be, I guess...
Then they should cut.
Yeah,
and they should cut more aggressively.
Yeah. And is there risk that they cut more aggressively and say like inflation is moving in the States that creates an inflationary environment in New Zealand?
It will create an inflationary environment, but I think we need an inflationary environment. And I don't think we need an inflationary environment that's, running away and is too high and is 7% again, but we're within the target bounds and it's going down. And if the economy slows down much more, we will be in a real tough scenario. So I would say actually they should cut. And remember, we're not at stimulatory interest rates yet. We're not even at neutral interest rates. We need to get lower before we are stimulating the economy back into life. So we're not even like we've got the foot on the floor in terms of the gas. We're just lifted off the brake and we're coasting. Yeah.
Okay. So your prediction is 0.25.
0.25, yeah. But I think it should be 0.5.
Because you're worried that if we don't go to 0.5, that our economy is going to really struggle.
All we have had is a sentiment shift, right? Business performance numbers aren't booming. There's no price increases across asset classes really. If we get into a situation where sentiment shifts back to the negative because of what's happening geopolitically and trade-wise globally, that is a terrible situation for the country to be in. So I think cut another 0.5, let everyone know, hey, we're not going to run away with this, but the RBNZ's got your back, and we need to pump some life into the economy because it's not performing well.
So you think 0.25, but
I think it should be 0.5.
Okay.
I would, if I was a betting man, I'd put my house on 0.25, but I think it should be 0.5.
All right, Michael. Well, it's time to spill some tea. We have some inside goss on Adrian Orr and why he left the Reserve Bank, and we will talk about it after the break.
Don't talk to the banks, talk to a mortgage broker. At Lighthouse Mortgages, we help you find the right loan with the right structure at the right price. No more guesswork, no stress. Get in touch with us via the show notes below. Now, back to the episode.
Okay, Mike. So let's talk about Adrian Orr. We got a little bit of news on maybe why he left the Reserve Bank. Do you like a little tea, a little bit of goss?
Nah, not me, mate. Hate gossip.
So Adrian Orr officially stepped down as the RBNZ governor on March 26th. So it was a few weeks ago. Were you surprised?
Yeah, I was definitely surprised. I'm not sure why he chose to resign. And I'm not sure that it was just weird timing.
Because he still had 12 months left, right? Which is a decent amount of time. So the speculation is that he resigned due to some tensions with the finance minister, Nicola Willis.
That's interesting because they're meant to be independent of each other completely.
Essentially, he was a strong advocate for higher bank capital requirements, essentially making sure the banks hold on to more money.
Yeah.
Do you think that's a good idea?
No, I think their reserve requirements are adequate as they stand. Ever since Basel III, 20 odd years ago now, which is designed to prevent another 2008 GFC, the capital requirements of most retail banks are far in excess of what's required.
And if you actually want to create any competition, right, you keep increasing those.
Well, they're actually set to go up again. I was talking to the head of finance of one of the banks the other day, and they were basically like, interest rates are going to go up another 0.5 at some point in the future when we have to keep retaining more capital, right? Because they can't lend it out.
Yeah. So Willis agrees with you, and she's gone, well, I actually want to loosen these rules, arguing that it might be pushing up lending costs and limiting access to credit if you increase those limits.
I completely agree with her. If they remove triple CFA regulation or pare it back significantly so it's practical for banks, and also maybe not reduce the capital requirements, but don't add any additional reserve requirements, then 100%.
Yeah.
And again, I acknowledge my conflict of interest here. I'm a mortgage broker. I like kind of money being available to customers, but your credit is the oil in the engine, right? Like if when capital markets and an economy seize, so does the economy. And we've seen that time and time again. The harder you make it for businesses, for consumers to obtain credit, kind of the worse it is for everyone.
Yeah. So I mean, clearly Adrian Orr was very passionate about this subject and enough to walk away off the back of it.
He was passionately wrong.
Yep. Well, that's why he's walked away.
Yeah.
So the RBNZ did make an announcement of a formal review of these capital requirements, and some speculate that might be the tipping point.
Yeah.
So there you go. That's why Adrian Orr...
The reason why I sigh and look down and I get annoyed at this is because all you are doing, I know they're doing it under the guise of like consumer safety and safety of the banking system. We have a very sound banking system as is. And to be honest, like all you are doing is stopping the transfer of wealth from older generations to the younger generations by making it harder for them to obtain credit. And I'm not saying we just have to go out and sell each other more expensive houses for the economy to be doing well. But like fundamentally, you have made it easy for people to get credit and build their wealth off the back of that credit. You then pull the ladder up a little bit, and it means that younger generations can't do the same thing, right? And I find that like extremely frustrating.
So the question is, Mike, Adrian Orr is out of the picture.
Yeah.
He was the leader within the RBNZ. While the tone might not change immediately, potentially it does, do you think the tone of the Reserve Bank will change over the next 12, 18 months?
It's just hard to say because, like Karen Silk's an ex-banker. So, potentially she takes a little bit more of a bank-friendly approach, although Adrian used to work for the banks.
I mean, really important to point out that, the RBNZ is obviously like a data-driven institution. So while they do have different leadership, it's not like things are going to change overnight, right?
It's also not just Adrian or the Reserve Bank governor who makes the decision. It's a panel. So, we put the pin on Adrian, but at the end of the day, like it's a group of them making the decision, and basically they've been unanimous for quite some time. So the sentiment might not actually change, even though Adrian's out and someone else comes in.
Yeah. So Mike, moving back to the OCR announcement on Wednesday. So in February, we both did call 50 bips, and we both were right.
Yeah.
So we're both calling 20. I say I agree with you. I think 25 as well. What's it actually going to mean for Kiwis?
Not much is going to change in the short term. Most Kiwis are kind of weighted on those 6 months and 1 year fixed term rates. They're not so closely tied to the official cash rate. And we haven't seen a lot of them being passed through previously, like a 50 basis point cut. The short term rates haven't dropped that much. I don't think it's going to mean a huge amount in the short term. What will it mean for the economy? Again, in the short term, not too much. Like you need bigger cuts to stimulate the economy. And I think with all of the rest of the uncertainty out there, 0.25 isn't enough.
Is the 25 bips already built into say...
It's already priced in basically, yeah.
Yeah, okay. And I like to get a little bit of personalized mortgage advice in there. Generally speaking, not personalized advice. What are you seeing? The conversations you're having with clients, are you still saying 6 months? Are you starting to move more towards 1 year?
No, there's too much margin in those 6 month rates at the moment. So we are actually, for a lot of our customers, saying the 1 year rate is more attractive just in terms of the price. At the moment, $499 for 1 year is the best we're getting. We'll see how that shakes out after the official cash rate announcement. But yeah, that's, when you're looking at, mid fives versus $499 for 1 year, I don't think it makes sense to be going for a 6 month rate for a lot of people just based on price.
Okay. And with all this uncertainty, let's get your prediction. 1 year home loan rate by the end of the year. Where do you think we're landing?
I have no idea anymore. And the reason
Why don't you have any idea anymore?
Because of all the uncertainty that's going on, right? And it may be lower than I thought it was going to be, but very well maybe higher than I thought it was going to be as well. Sitting here today, I don't accurately have a guess for what it's going to be. Usually I do, and I'm happy to say it. At the moment, I think I'd be doing everyone a disservice if I threw one out.
There you go. I think there's a learning within that as well, right? The environment's always uncertain. There's particularly quite a few moving pieces at the moment. The main thing, though, is looking at your situation and not just going, what's happening over the next 6 months, but where do I want to be in 3 years, 5 years, 10 years, and just really making those long, smart plays. Much love to Lighthouse Financial for sponsoring this episode. Please subscribe to the channel. Please give us a review and give us a like, and we'll catch you next time.
Cheers.